Okay. Hi everyone. Today we are going to present the financial statement analysis of our target company, Empire Company Limited. We are a team of 5 members. It will be presented by Anshu, Purni, Sumit, Nistha, and Spreet. Now let's begin with Purni.
Hello, my name is Purnima Rai, and today I will present on the introduction and the company overview. Firstly, let me give the introduction to our presentation. Our presentation mainly focuses on Empire Company Limited, which is a major player in Canada's grocery retail and real estate sectors. The purpose of our work is to analyze the company's financial statement and evaluate its overall performance and stability. In addition to this, we also have considered the viewpoint of a banker, examining whether Empire is financially suitable for long-term commitments. Now, this also allows us to highlight the company's strengths, its risks, and its position in the market form, both in an operational as well as the financial perspective. Next is the company overview. Uh, Empire Company Limited was founded in 1907, beginning with the Sobeys. Since then, it has grown into one of the Canada's largest food retailers, and now it operates over 1,660 stores across the country under the five major uh, retail banners. Alongside the retail, the company has also built a strong real estate portfolio through partnerships with Crombie REIT and Genstar. The Empire has developed and managed several properties across Canada. This particular combination of retail and the real estate operations has strengthened the company's position in the Canadian market. With that, I will conclude my part of the presentation. The next section will be presented by my friend Sumit, who will take you through the financial analysis in detail. Thank you so much for your time and attention.
Thank you, Purni. Thank you so much. In our analysis of the Empire performance from 2020 to 2025, the number shows both growth and the challenges. The revenue grew from 26.7 billion in 2020 to 31.6 billion in 2025. But the growth slowed after 2022, just 0.45% in 2023. And speaking about the EBIT increased. It increased from 2021, it was 1.25 billion, and then it fell to nearly 16% in 2023, showing the cost pressure from both the inflation and the operations. The net income followed a similar trend, rising to 811 million in 2022, but dropping by over 10% in 2023. And in the balance sheet side, if you see there, the equity is nearly 38% across the period. It is over the period of 5 years, it is 38%, while the long-term debt has fallen drastically. That means that is a good sign for the company. It was earlier in 2020, it was $6.6 billion, while in 25, it was just $1.1 billion. That is, it is improving its solvency, including improving its liquidity. From the vertical perspective, cost of goods sold, we can call the COGS. COGS stayed steadily at 74 to 75%, constituting a major portion of the cost, and leaving the margins very thin. Net income margins was around 2 to 3%. That is typical for the grocery retail industry. And the key takeaways from this is that there is a strong equity position, and reduced debt, but the profitability is decreasing and the margins are very low, right? Coming to the next slide, we have the financial statement analysis. Financial statement analysis, we will be doing about talking about the liquidity ratios and the profitability ratios. The current ratio stayed below 1%, in every year. That is from moving from 0.992 to 0.77 in 25. So this means that the liabilities consistently exceeds the assets, raising a red flags for the banks. And this is also very risk factor for the short-term insolvency. The quick ratio was also even weaker, falling from 0.49 in 2021 to just 0.31 in 25, meaning that liquid assets are less than 40% of the short-term obligations. That is also another red flag. So profitability, on the other hand, is stable, but net margins remain around 2.3 to 2.7 percentage. That means it is a standard for the grocery industry, but it is a bit lower than these competitors like Loblaw and Metro. Return on equity is also decreasing from 16% in 2021 to around 13% in 2023. So this is another weaker shareholder. This is going to be the weaker for the shareholders. And from the banker's point of view, this mix of Empire is profitable, but the operations are very tight liquidity. The operations is running on very tight liquidity, making the cash flow management a very crucial factor. Going to the financial statement analysis part two, we are going to talk about the efficiency ratio and the financial leverage ratio. So, efficiency ratio is a gradually weakening. Inventory turnover fell from 14 times in 2021 to 12.5 times in 25, while the days in inventory increased from 26 to 29 days. Slower inventory movement can add the additional cost to the company, because we are trading, the company is trading in the perishable goods also. So receivable turnover declined from 52 in 21 to 47 in 25. That means we have decreased our collection time. The company has decreased its collection times, and that is good for the company, for this such type of companies. And asset turnover ratio remains same for over the period. That means the revenue generation from the assets is consistent over the period. So on leverage, Empire made a significant progress that we can say. Debt equity ratio has fallen down from 2.44 to just 2.1. That means the loan amount has decreased from the 6.6 billion to something 1 point something billions, right? So this is reflecting the company is not reliant on the debt, but the interest coverage ratio is 4.6 times. That is weaker than the competitors. Meaning that there is less buffer to service debt if the earnings are low. So overall efficiency is solid, but it is solid, but it is sleeping. That means with the leverage improvement and only with the leverage improvement there can be the stronger solvency. For bankers, for us, since we are acting as bankers, this means the empire is stable, long term, stable in long term, but requires to manage its liquidity and its coverage ratios. So the next part will be done by my teammate Nista. So I hand over it to her. Thank you.
Thank you, Sumit, for the great analysis. So now let's move on to the trend and benchmark comparison for Empire Company. The current trend shows that Empire is lagging behind its competitor when it comes to liquidity. Its current ratio is only 0.80 compared to the industry average of 1.16, and the quick ratio is also the lowest at 0.34. This indicates that Empire has less ability to cover its short-term obligations, which is a major area of concern. So, at the same time, Empire faces tough competition from George Weston and Metro, who are performing better in several financial aspects. However, there are some clear strengths for Empire as well. So, looking for the efficiency ratio, Empire is actually ahead of its peers. Its inventory turnover is 12.79, much higher than the industry average, and its receivable turnover is leading at 45. This shows that company is managing inventory effectively and collecting cash from customer much faster than its competitors. When it's come to profitability, the story is mixed. Empire profit margin and return on assets are slightly behind the industry, but it makes up for this with the highest return of equity at 13.81%. This suggests that despite lower margins, the company is still creating strong value for its shareholders. Finally, if we consider financial leverage, Empire debt to equity ratio stands at 2.07, which is higher than Metro's one. And the industry average, this means that the company is more reliant and debt financing, while not alarming. This is an area where further improvement could strengthen its financial positions. So, to wrap this up, Empire struggles with liquidity and leverage, faces strong competition from industry leaders, but demonstrate real strength in efficiency and shareholders' returns. By improving its liquidity management and optimizing leverages, the company can position itself more competitively in the market. So next slide will be presented by Anshu.
Thank you, Nishta. So from the next slide, we can see the prioritizes as a banker. When looking at Empire's company through the eyes of a banker, four things stand out. First one is the liquidity. Then second one is the solvency. Third one is the efficiency, and the fourth one is the stability of revenues. So starting with the liquidity, Empire's current ratio is 0.80 and its quick ratio is 0.34. Both are lower than the industry average. So this means the company carries more short-term liabilities than assets, which could create a pressure or cash flow or limit flexibility. Even so, the company has managed to keep the liquidity consistent over time, but showing it a careful financial planning despite of the low levels margin. Solvency looks better for Empires. Empires has reduced its long-term debt and debt to equity ratio is within the marginable range. The interest coverage ratio is like 3.64 and shows that it's enough for to comfortably pay the interest, which lowers the risk from a banker's perspective. So another point is that diversification. Alongside groceries, Empire's real estate operations provide a steady and a predictable income. This reduces the exposure of the real estate operations and the demand. Even in the period of like weaker consumption also, Empire has kept its profit at the higher margin, relatively stable. That kind of resilience of it's important for its lenders to see. So for the next slides, we have the applications of the ratios. So now, when applying ratios with a banker's focus, leverage becomes the critical one. Okay, so the debt to the equity ratio shows that while Empire leans on short-term liability, its overall financial risk has decreased with reduced long-term debt. The terms interest earned ratio confirms strong capacity to service the debt. So the main concern remains the liquidity. We also talked about earlier also, like with the current ratio of 0.80 and a quick ratio of 0.34, liability exceeds the assets. This signals the company should improve its short-term liability to maintain the flexibility and found projects. Okay, still, efficiency and profitability provide a balance between the two. Empire is not weak in generating cash, I must say that, but its operational demonstrate enough stability to offset some of the basic risk. From a banker standpoint, that is a mixed perspective, makes the company credit worthy overall. Overall, I will say, often though liquidity is the main area like to watch it mostly closely. Like so from the next part, I will hand over it to my fellow teammates. Preet.
Thank you, Anshu. Next is risk assessments. In high market competitions, the grocery industry is highly competitive, especially with dominant players such as Metro, Walmart, and Loblaws. These larger retailers benefit from economic of scale, stronger brand identification, and more extensive supply chains. This intense competition can reduce our market share, pressure pricing strategies, and impact profitability. Like in weak liquidity position, the current liquidity position of the business is not stronger enough to comfortably meet short term obligations. Insufficient liquidity can lead to delayed supplier payments, missed opportunities, or even operational disturbance. Without improvement, this could harm financial stability and limit our ability to respond to unexpected expenses or changes in the market. Moving to the next slide, decision and justification, continuing engagement with Empire Company. As a banking official, I recommend that maintain engagement with Empire Company. This recommendation is based on a balanced assessment of the company's operations, financial health, and risk profile. Stable operations in essential sector. Empire operates primarily in grocery and real estate, two sectors that tend to offer consistent revenue streams. Groceries provide stable, recurring cash flow due to consistent consumer demand, while real estate's assets contribute long-term value and potential for appreciation. This operational foundation gave the company flexibility even in uncertain economic conditions. In liquidity management, while it is noticed that Empire has higher current liabilities, which can pressure short-term liquidity, this risk is manageable. The company appears capable of covering these obligations over time through its steady operations and strategic asset management. With proper financial failure, the liquidity position can be improved. In in positive debt reduction, a key strategy is that Empire has reduced its long-term debts. This demonstrates responsible financial management and a commitment to delivering. Lower long-term debt means less interest burden and improved financial flexibility, which is a positive indicator for future stability and growth. Overall, dispute some liquidity concerns, Empire's operational stability and efforts to reduce debt support the case for continued banking engagement with regular monitoring and appropriate risk management. The company remains a viable and strategically sound client. Next slide. References. This slide lists the main references that informs the research and data presented. They consist of pre-reviewed journals, industry reports, and company publications that validate our understanding. Here is the full list of the references. Thank you. I appreciate your time and interest. Thank you.
Thank you, everyone.